Welcome to In the Hot Seat with the Tenney Group. I'm Spencer Tenney. It's good to be with you. I'm extremely excited about our episode today. With us, we have Matthew Wiener, Managing Director and Practice Leader of Aon's Transaction Solutions. Matthew, welcome.
Spencer, thanks for having me this afternoon.
We're going to jump right in here. You ready to heat things up?
Let's do it.
All right. So one of the reasons that we have you on here is just this M&A, insurance, the overlap between the two, and how deals are getting done. A lot of different things happening. So let's just talk about how you got to Aon. Tell us about that and why. I know that you're a former attorney. What's the connection between M&A and how did you come to being a part of the Aon Transaction Solutions team?
Yeah, sure. So I was a practicing attorney for about 6 years, focused primarily in the energy and infrastructure space based here in Houston. And towards the end of my legal practice, we started seeing parties changing the way in which they were doing their mergers and acquisitions, namely trying to find ways to take the allocation of risk between the parties and looking for ways to really kind of shift that risk away. And so Aon was really one of the leaders in helping to develop products and solutions to address that particular focus. And so they were looking for someone about 7+ years ago to join their team and really help grow that solution offering and to have particular subject matter expertise in energy and infrastructure. So it's always a fun conversation with your wife and your parents when you say, I'm leaving my cush law firm job to go basically sell insurance. But it's ended up being a phenomenal career move, and I've had a great time getting to meet people like yourselves and others that I wouldn't have had the opportunity to do, and just to see how prolific kind of the use of the products and solutions that we do has become in the world of M&A.
Well, thank you for that kind of backdrop. I think that will help us as we kind of jump into this conversation. So let's just talk about trends. The last 24 months in particular, what have you noticed as far as trends in M&A that our audience should take notice of?
Sure. So, if you think back 5+ years ago, the way most parties would do an M&A transaction is they would come to some determination of valuation, and then the buyer would be given kind of the opportunity to do its due diligence, and they would negotiate a purchase agreement, and then generally they would agree upon some type of indemnification structure where the buyer would say, look, we think we know everything about this business, that's why we're comfortable paying this amount. But if it turns out that something was missed or you failed to disclose something to us, we want to know that we have some type of recourse. So you would see the parties negotiate escrow holdbacks or some other type of indemnification. That became an area that our clients, primarily private equity funds at the time, were keenly focused on how do we take that risk and really shift it away from the parties. And so the evolution of M&A insurance came about, with the idea being, let's find a way to let parties transact like they normally would. But at closing, rather than a buyer seeking recourse against a seller, it will seek recourse against an insurance policy that should provide for substantially better benefits. And the seller is able to take away all the proceeds at closing and not have to worry about some claim coming in from a buyer a year or two later. And so over the last 24 months, it's really been a continuing trend over the last 5 years. We've continued to see the use of M&A insurance in private transactions really just skyrocket. And so, I think when we look at the last 2 years, based on statistics we see from the American Bar Association with their deal point studies and other data aggregators, approximately 50% of all private transactions have been using M&A insurance. And when you look at, interestingly, private equity funds and sponsors, the number goes up to 75%. And so in particular, as we came out of COVID, which was an interesting year in 2020 where we saw, I think, all globally, we saw M&A activity really coming down prolifically. As we moved into that fourth quarter of 2020 and then continuing through 2021, M&A activity exploded. And I think any service provider, whether you were a banker, a lawyer, an accountant, or someone in my profession, there was more transactions than really there was people staffed to work on those transactions. And it became very much a seller's market, at least it felt like from our perspective. And every seller that we were working with wanted to implement a clean exit strategy, meaning they want to negotiate a PSA, sign on the dotted line, and move on. And so we really saw the use of insurance explode so much last year that we ran into capacity constraints where the insurance carriers that we work with did not physically have enough human beings to underwrite the number of transactions that were coming in. And just to give you kind of a data point, probably in 2019, which is a more comparable year, you would see on average, maybe 100 plus transactions a week going in to receive term sheets from insurance companies. Last year, that number was routinely 250 to 300 transactions per week. And so that trend just continued really throughout the year and really led to this massive increase in utilization of insurance in the M&A space. So that was, by far and large, probably the largest trend we saw was just the sheer volume of transactions requiring insurance. And then there were some unique kind of bespoke, what I call trends that we can talk about in a bit that were maybe specific to the transportation and logistics industries.
I mean, I think that's fascinating. And just to echo that, we certainly saw that, especially within Q4, many of our deals in which, to your point, it became a major bandwidth challenge as far as like from the insurance companies, depending on how far along you were and how long you had, as far as a window to close, was that even on the table based on the amount of just pure volume of transactions that people were dealing with. So that's really interesting to hear it from your vantage point. Now, one thing that's evolved over the last couple of years is as far as the profile of the companies that are actually being purchased in terms of what is the typical profile that would likely attract a policy like this. And so what can you tell us about maybe over the last 2 years of, maybe what was the minimum size of a transaction that would involve reps and warrants insurance versus maybe today? How has it changed?
Sure. So if we go back a few years, most insurance carriers really preferred to underwrite transactions with an enterprise value over 100 million. They tended to prefer transactions where the seller was a well-known entity, whether it was a known private equity fund or known corporate strategic, and they tended to prefer to work with buyers who were undertaking significant third-party due diligence. They weren't necessarily comfortable working with a buyer who was doing all that diligence internally. And we saw higher premiums, of course, and general terms that weren't anywhere close to what they are today. Fast forward to 2022. First thing I'll highlight is that we are now at a place after Q1 where the capacity and bandwidth has increased exponentially from what you and your clients saw last year. So we're no longer having challenges finding insurance capacity. We've seen rates coming down from really kind of the peaks that they were at in the fourth quarter. And we've seen general kind of appetite to underwrite new and unique transactions also increase. To answer your question, kind of the typical transaction profile today, I'm happy to say is that really it can touch just about any industry, almost any transaction size, and really any type of kind of buyer or seller profile. And so what I mean by that is because of the number of new insurance carriers who have come into this space over the last few years, that appetite to really expand what they're willing to underwrite has grown significantly. So I would say that today, certainly we're underwriting transactions at the $50 million enterprise value routinely. We've worked on transactions as small as $10 to $15 million in purchase price. I think when you think about an insurance policy, there's going to be a minimum cost to put one of these policies in place. And as a general matter, I think a $200,000 to $300,000 total cost is a good estimate to use. And so I think at the lower end of the enterprise value, it becomes more of a cost-benefit analysis for clients as to whether they think incurring that upfront cost justifies the risk that they're trying to insure with the policy. So transaction size, again, probably 20 to 30 million is the sweet spot on the lower end of the spectrum, and then really no issues on the other end. We've insured transactions north of $20 billion in enterprise value, so no real issues on the other end of the spectrum. The target profile, insurers are now fine underwriting family-owned businesses or sole proprietor type businesses. They're routinely underwriting carve-out transactions, so we've got public companies or other types of entities spinning off select assets or businesses. Those are certainly insurable. And then in terms of industries and sectors, really most industries and sectors are insurable. And in particular, transportation, logistics, and infrastructure are markets or sectors that the carriers that we work with have a strong appetite for.
So let's talk about transportation. And you mentioned the underwriter and like what are the insurers particularly interested in as they're evaluating the risk through that underwriting process for reps and warrant insurance?
Yeah, so think about it in terms of the insurance carrier is basically replacing the indemnity that a buyer would have had from a seller. And so what the insurance carrier wants to confirm is that the buyer has undertaken the same kind of scope of due diligence that it would have otherwise have undertaken if it were seeking an indemnity against the seller, right? So what they don't want to see is that, well, you decided to use insurance, and so you said, why do we even need to do due diligence? These guys are just going to, pay us for anything, that comes out of the woodwork. And so what they're looking for is they're going to look at the scopes of representations and warranties that are included in a purchase agreement, and they want to ask the buyer how it's gotten comfortable that those representations and warranties are true, and what's the basis for that assessment. So I would say, as a general matter, they're going to expect that legal counsel has been engaged and is conducting ordinary course legal due diligence, including confirming that the target's operated in compliance with the laws and regulations to which it's subject to. They'll generally also want to see due diligence around any types of tax exposures, right? So if you're acquiring the actual entity or the equity of a company, that you've diligenced that target's paid the taxes historically that's required to pay and made the right filings. And then financial statement due diligence, right? Which happens to actually be the type of representation we see most commonly breached, where you have a seller providing financials and saying these are accurate in all material respects. The insurance carrier will want to confirm the buyer's actually done some level of financial due diligence to get comfortable that that's true. And so I would say legal, tax, and financial are kind of the three key areas that you'll expect diligence to have been done on any transaction. But in particular for transportation, I would say there's probably two other areas that come up very often and frequently due simply to the nature of the potential liability. So the first is condition of assets. So you will routinely see sellers when they're selling a transportation company that includes a lot of assets, for example, trucking assets or trailers, make a representation that the historic CapEx that they've reserved for maintenance and repairs has been sufficient, that the assets are fit for their intended purpose and sufficient for use. And so interestingly, we've had transactions where buyers haven't done a lot of due diligence around the physical condition of the assets, and subsequently to closing discovered a lot of money has to get put into this equipment to bring it to working order, and they made claims against the policies and been reimbursed. So the insurance carriers today are going to be very focused on a buyer's diligence around the physical condition of the assets being acquired. The other area, simply because of the nature of employment with respect to a lot of transportation companies, is diligence around compliance with wage and hour laws, and understanding if a company that's being acquired has been classifying employees as independent contractors versus employees, or exempt versus non-exempt. These are particularly important, just given that we do see a lot of employees in this space being designated as independent contractors, and with that comes a lot of inherent liability. So those are going to be two key areas specific to transportation that insurance carriers and underwriters will pay a lot of attention to.
I think that's fascinating. So, what would be some best practices for those that may be looking at a transaction 12 to 18 months out? What should they be doing to make sure that they can satisfy the underwriting process should this product be necessary to close the deal?
Sure. So I'll address it kind of from a sell side and a buy side perspective. So if you're a seller and you anticipate that you're going to be going to market in the next 12 to 18 months and running an auction process and looking to sell your company, I think first and foremost, you're going to want to work with your investment banker to make sure that you're going to have the right information to populate the data room with, and that if you have financial statements that aren't audited, that you've discussed whether getting kind of a pre-auction process quality of earnings is going to make sense. That will certainly help expedite and facilitate the process when buyers come in. I think it's just critical that the client works with their bankers and lawyers to make sure that they've got kind of the process wrapped up into a structure that will be conducive to using reps and warranties insurance. The good news as a seller is that when you contemplate or utilize a structure that desires that a buyer use a policy as opposed to seeking recourse to a seller, for the most part, this is a very well-known, well-respected transaction structure. It's not going to be something that buyers are going to look at and say, what is this? Most buyers will be accustomed to it and will be willing to entertain it. And as the seller, that's great because your involvement in that process is going to be very minimal. Your only obligations are what are governed under the purchase agreement. And so if your agreement says, look, buyer, don't look to us for recourse, look solely to the policy, you just want to make sure that you're giving the buyer kind of the information it needs so that it can satisfy the underwriting requirements to get a policy issued. So for a seller, it's really just kind of prepping your process to use reps and warranties insurance. On the counter side, if you're a buyer and you're looking at a transaction, that you think you're going to be utilizing insurance for. I think it's important that the buyer coordinate with its attorneys and its insurance broker to make sure that it has a good understanding of what's going to be required for that specific transaction. So I've given you, Spencer, just some high-level kind of guidelines on what is typically expected for a business in the transportation space, but it's going to be very target specific, right? And if you're buying perhaps a third-party logistics software company, where what you're buying is software, intellectual property, that's going to be a different set of criteria for what's going to be of interest or focus to an insurer. So I think it's important for the buyer to get out in front of this very early on, work with its advisors to make sure it's very clear on what does the underwriter expect. Do we know what the costs are going to look like? Do we know if there's any coverage exceptions? So that all of those things can be incorporated into what's ultimately the purchase agreement that it's going to sign with the seller.
So what would you say, all things are as seamless as they can possibly be. What should a buyer and seller expect from an underwriting time? How long does it take? Because days kill deals. You and I know this very clearly. So what does that look like in terms of days adding to the process?
Yeah, so this entire process, start to finish, is probably 10 to 14 business days. We've certainly done it in shorter time frames. I don't like to highlight that. I don't want our listeners to call me and say, "Hey, you said you could do it in less than a week. We've got to sign in 3 days. Let's get going." 10 to 14 days being engaged prior to signing will make this feel like a very streamlined and kind of easy process. And to be clear, you can start this process at any time that you want. It's not required that you wait till 2 weeks before signing, but that's really kind of the minimum amount of time that's required. And that's really broken up into two components. So the first is a 3 to 4 day marketing exercise where the insurance broker will go out on the client's behalf and on a confidential basis ask the insurers that write this type of insurance to provide term sheets. So they will, there will be 20 or so carriers that will look at a submission from the broker, and they will say, "Hey, we like it, and we're willing to underwrite on these terms and conditions." And so there's no cost to the client to do this, which is why we recommend they do this fairly early on, so that they have very clear line of sight on what the terms and conditions are, and can confirm that they actually are comfortable with those terms and will be using insurance. So that's about 3 to 4 days of that timeline I mentioned. Once the buyer has decided it likes the terms and actually wants to commence underwriting, the underwriting process is about 7 to 10 days. And that's the part of the process where the insurance company is going to be reviewing the buyer's due diligence. So some of the things we mentioned earlier, tax, legal, financial, condition of assets, they'll ask the buyer to produce whatever diligence reports it's had prepared. They'll ask to review the data room that the seller's populated, and they'll look to schedule a short underwriting call where they'll ask the buyer and its advisors questions around their scope of due diligence. And so, that entire process from picking up the phone to call a broker and get terms to having a policy fully underwritten and ready to bind, typically 10 to 14 business days.
I think that's such great information for our group. A couple more questions. So we talked about trends. We talked about the last 5 years. What are the things that you think that we're going to see that moving forward that may influence and affect how deals are going to get done in the future?
Sure. So a couple of things. I mean, clearly with what's going on kind of in the global economy, rising interest rates, inflation, I think that risk mitigation is going to become more and more important to parties in a transaction. So, we're seeing really high multiples being paid, access to capital has been pretty easy. And so I think investors are going to be certainly more focused on preserving IRR and protecting kind of what their investment thesis or valuation, what their valuation is predicated on. And so I think the ability to mitigate as much risk as you can in a transaction will be a continuing trend. Reps and warranties insurance is kind of one end of that risk mitigation strategy. And there's a lot of things that parties do to mitigate risk. But another area that we've seen that I think will continue to be a trend is insuring known issues, right? And so when we talk about a reps and warranties insurance policy, we're insuring a buyer against things that it doesn't know about. So it does its diligence. Anything that it knows about gets disclosed on the disclosure schedules. Parties, will perhaps have purchase price adjustments or work around kind of these known issues, but those aren't covered by a typical reps and warranties policy because they're known. We have seen a movement by our clients and the insurance carriers to also try to insure known issues, right? So it could be that the target is subject to a wage and hour class action suit, where a bunch of employees, have certified that they should have been designated as employees. They haven't. They feel they're owed pay, and so there's this massive lawsuit out there that's kind of pending. It may be that both the buyer and seller believe the lawsuit's meritless and that the seller did properly classify employees, but that's a big risk for one of the parties to wear. And so we're now seeing insurance companies saying, look, we're comfortable insuring that known risk. So they'll actually insure the outcome of a lawsuit, whether it's a plaintiff lawsuit or whether it's a judgment that the seller has won and is now on appeal. We've also seen tax issues becoming an area that are being insured. And so these are situations where the seller's taken certain tax positions. Perhaps it's carrying net operating losses on its financials, or it's classified as an S corporation, and there's concerns by the buyer as to whether it's been properly classified or elected to be treated as an S corp. These kind of known tax issues are becoming much more and more common and are being uncovered in tax due diligence. And so we're seeing buyers now looking to insure known tax positions. So I think when I look forward to the next kind of 2 to 3 years, I think you're going to see a continued push by clients and their advisors to try to find ways to shift these risks from the parties to someone else, i.e. perhaps an insurer. And so these kind of known issues are an area where we expect to see a lot of growth. And then I think, we'll just be very curious to see just generally, does M&A continue at the pace we've seen? I think a lot of people don't expect last year's pace to continue this year, but it certainly still seems like there's a lot of high quality assets out there, and access to capital still seems to be, relatively easy, so to speak. So I think just kind of predicting what the trends of M&A look like, will be something we'll all be focused on as well.
Well, thank you again for that insight here. I think we got one last question, perhaps a little wild card here. Now, I know that you were an attorney in a former life. You can probably appreciate attorneys can have a very impactful role at the deal table, sometimes positive, sometimes negative. So what advice would you give to business owners who discover that they've got the wrong attorney? How do you go about firing an attorney and getting the right attorney?
Well, what I can tell you is that when we have the privilege, kind of in our universe, to working with a lot of law firms and a lot of attorneys, and you definitely do see a difference in the way I would say almost specific attorneys approach a transaction. It's less so on a kind of law firm by law firm basis and very kind of attorney specific. So what I would say to anyone who's looking to engage a law firm or an attorney to represent them, either on the buy or sell side, I think it's important to interview, several potential law firms that you think can fit, the criteria that you have, and understanding their history, right? What transactions have they done with respect to the particular sector you're doing? Have they worked on transactions within kind of the size that your transaction is going to be? So I can't really give you advice on how to call a lawyer up and fire him, but what I can tell you is that as you think about, engaging a new lawyer or law firm, there's certainly nothing wrong with taking the approach of speaking to kind of multiple law firms or lawyers and really trying to see who you're going to be the most comfortable with. Because I think my parting message would be, I find almost all the attorneys we work with to be exceptionally bright and to really understand what it is that they're doing. But I think there are some attorneys who have a bit of a better business sense and sometimes are able to kind of move away from what be more of a legal esoteric point and to focus more on what the business issues are and what's really important to the client. And so I think doing kind of an interview process as a business owner, you can get a good feel for if someone is just a really good lawyer or also someone who really understands kind of how businesses and business owners think about things within the context of a transaction.
Well done, sir. Hey, listen, I really this is yeah, that was great. Hey, listen, thank you so much for taking the time to educate our network on just a really interesting trend that's affecting how we do business and how deals get done. Matthew, that's going to do it for us here. We will see you next time.